Okay, Holly, you're all set.
Thank you. Good morning, everybody. Welcome this morning. I'd like to call the meeting to order. The time is now 9:03. Stephanie, will you please take attendance?
Of course, good morning. Adrian Cochran. Oh, okay. Sorry, your mic's off. Andrea Comer.
Sorry, present. I'm muted for background noise.
Oh, no problem. Andrea has not joined us yet. Ellen will not be joining us. Mike Soltis.
Here.
And Holly Williams.
Present.
All right, we do not have a quorum.
Thank you. And I'd like to take a moment to thank and welcome any members of the public for joining us this morning. In light of the fact that we don't yet have a quorum, we're going to table item number 2, which is the review and approval of the September 22nd, 2023 meeting minutes, and transition to item number 3, which is a presentation of the audited financials for the fiscal year that just ended June 30th, 2023. And Markham is going to present that for us. Markham, if you could please start your presentation.
Great. Thank you, Holly. Good morning, everyone. Thank you for the opportunity to present. I'd like to have Damien share a screen, which looks like is in progress. So this morning, we'll walk you through our audit presentation. I'm Chris Jackson. I'm the audit partner. I'm joined by Damien Kogel, who's a director on the audit, and Ashley DeBarros, who's a supervisor as well. So we'll walk you through our presentation. Feel free to ask questions as we're going through, or we can certainly have time at the end for questions. And if we're going too quickly, just let us know. I know the financial statements were provided in advance. We issued the authority's financial statements on November 8th, and those financial statements contained an unmodified audit opinion, which is the highest level of audit assurance, which is always great news. We met with Holly prior to the issuance of those financial statements. This slide really just covers the key points that we'll be going through this morning, and we might as well jump right in with the areas of audit emphasis on the next slide, which is focusing on contributions. And these areas of audit emphasis are the areas that we spent the majority of our time during the course of the audit. Here we've got contributions receivable. You can see that there's a 7% increase this year, and that really reflects overall increases in the contribution revenue as well. So it does line up exactly with the contribution revenues up 7%, and the receivables are up approximately 7%. And that increase is in line with expectations, in addition to just the higher wages that are reported by the employers, in addition to some outreach by the authority to make sure that employers are contributing and participating in the plan. So that was in line with our expectations. The authority did not record an allowance for uncollectible contributions. The way the contributions receivable are recorded, it's based on subsequent collections on those, basically through the month of August of 2023. So as those contributions are collected subsequent to year end pertaining to coverage prior to July 1st, a receivable is recorded by the authority. We performed extensive testing on contributions receivable and the revenue and had no exceptions or issues as it pertains to contributions. Benefit, claims expense, and reserves, the next area of audit emphasis. This is where we spent the majority of our time. You can see that claims expense increased this year to $314 million compared to $144 million in 2022. That increase is primarily due to the fact that last year there were only 6 months of eligibility for claim benefits. So you've got a full year of claims in 2023. In addition, the average weekly benefit amount increased this year by approximately 14%. So we see that in the expense and also in the reserves. Actuaries from Spring, who I can see are on the call, they prepared the actuarial report. That methodology was described in the report, and we went through and tested that. And that came up with reserves at the end of the year of approximately $52 million compared to $40 million in the prior year. The components of those reserves are on the table in the bottom of the page here. And the majority of that increase in reserves is in the case reserves themselves. And those case reserves represent the approved open claims that are in the process of being paid by AFLAC and represents the remaining amounts to be paid over the remainder of the leave as of a point in time as of June 30th. And the majority of that increase in reserves relates to pregnancy and bonding, in addition to own health case reserves. The other areas of reserve category stayed, relatively consistent with the prior year. The pending claim reserves are actually flat. And a key driver of that really is that even though claims expense and activity has increased, there's no buildup in pending claims. They're getting into the cycle, they're getting processed by AFLAC which is seeing them move and shift to additional case reserves. They're not really claims hung up, as their backlog is actually down from the prior year. The amount of claims outstanding and pending status have decreased this year compared to last year, even though the claims activity is up. So a lot of activity there, a lot of information. I apologize for getting way too into the details here, but just so that you're all aware that it is a significant area of focus of ours. The next slide actually goes through our audit approach. We reserved that methodology that was in the spring report. We also test the inputs back to the underlying supporting reports, and we tested those reports by drilling down and testing a sample of paid claims. We also focused on a sample of denied claims. We also reviewed claims that were paid subsequent to June 30, 2023, just to analyze the trends and to verify the adequacy of those reserves. We used an actuarial consultant ourselves to go through and spend some time reviewing the spring report as well as the assumptions. In addition to all of that, we performed what we call a hindsight review of the 2022 reserves. We looked at the reserves that were reported last year, looked at payments subsequent to year-ended trends just to verify that those reserves were not materially misstated as of last year, just as a point of reference, and that helps us to get credibility with the current reserves. We noted no indications that the prior year reserves were materially misstated, so that's all positive. So it's all very good things when we went through and we got totally comfortable with the reserve balances. The next area of focus is on subscription-based information technology arrangements, and that's a new GASB that was effective in 2023, and it basically requires contracts with subscription-based technology agreements. And those, for example, are cloud-based agreements with software. Salesforce is a big one here. So those contracts basically have to be put on your balance sheet, and basically it results in a right to use asset, which is really you take the present value of all the future payments on those over the terms of the agreement. You take that and you record that as a right of use asset, and you record a corresponding liability, basically the same amount when you adopted this. So you can see in the table below, you've got $3,222,000 of assets, $3,222,000 of liabilities, so it had no impact on fiduciary net position. And then during the course of the year, there was a small variance between the asset and liability, and that just relates to the fact that the amortization of the asset is a little different period than the amount of the payments over time. So it's not overly material to the authority. However, we just wanted to point out because it is a change in accounting principle. It was required to be adopted this year. It was adopted at the beginning of the year, and the 2022 financial statements were not required to be restated for this. It just flowed through the beginning balance. And just so you're aware of it, the authority spent some time going through the inventory just to make sure that they had captured all the agreements here. And again, just wanted you to be aware of the new accounting pronouncement this year. On the next slide, we've got investments. It's good to see that the investment portfolio has increased to $486 million compared to $370 million last year. That investment portfolio is in the state's short-term investment fund. The nice thing about that, with the increase in interest rates, you did have a nice yield and some investment income of $17 million this year compared to $981,000 last year, driven by the increase in the balance and the increase in the rate. So again, it's good to see the funds growing that will be available for benefits. No issues that we had with respect to investments. The next area deals with the debt. The next slide, and we can see that the first bond repayment was $1.6 million this year. So the bond balance went down from 16 to 14.4. That was made in June. So that's the driver of the decrease. The period of the bonds were negotiated this year. It would be a 10-year repayment, and the interest rate is 3.5%, which resulted in interest expense being reported of $560,000. I also wanted to point out that the seed funds, which had a balance of $1.3 million at the end of last year, were fully repaid during fiscal year 2023 with a payment that was made prior to October 1st in accordance with the agreement. So again, no issues here. Just want to give you an update with respect to changes and the debt of the authority for the year. Damien's going to walk you through the pension plan next.
Yes, good morning. So the next couple of slides, I'll take you through the defined benefit pension plan, or the CERS plan, and the other post-retirement plan. Both of these plans were, the liabilities were actuarially developed. For the CERS plan, it was developed by Kavanaugh McDonald, and for the OPEB plan, it was by the Siegel Group. Both of these were determined at the state level, and then the Office of the State Auditors took that information and allocated the liabilities to the authority based on the proportionate contribution for the authority over those periods. I just wanted to point out here that there were increases in the liabilities year over year, and that's primarily driven by the proportionate share of the contribution. And that's true for both plans, both the SERS and the OPEB plan. For the SERS plan, the proportionate share in 2022 was 0.251%, and that increased to 0.428% for fiscal 2023. I'm going to flip to the next slide that has the other post-employment benefit plan, or the OPEB. Similarly, the Siegel Group, they took the same approach, and the percentage contribution for that, proportionate contribution for that plan in 2022 was 0.0264% compared to 0.0623% in 2023, which is the primary driver for the increase in the liabilities year over year. So after those reports were developed, as I stated before, the state auditors of public accounts took the certain schedules and they basically audited those schedules and then allocated it to the various state agencies. And as a result of those allocations, the authority booked those recommended liabilities on the statement, the audited financial statements. Markham, from our perspective, we reviewed the state auditor's report. We tied out some of the information to detailed reports provided by management, and we did some general testing over payroll to just ensure that the information that was provided is reconciled and tested back to the records that were provided by management. The next 3 slides really talks about our required communications. It's pretty general and broad, just to cover to the committee and those charged with governance some of the procedures that we did. Just to highlight a few, the substantive accounting estimates that Chris and I just discussed, that we detail tested those to just ensure that the estimates provided for those accounts are reasonable. And as Chris mentioned, you know, for a couple of them, we went back and did hindsight reviews just to make sure that prior year, there was nothing significant that changed that would impact the current year. In addition, we noted no fraud or illegal acts based on procedures that we performed and discussions that we held with management throughout the process. Other information to communicate is that we read the MD&A and other supplemental information, but we do not express an opinion on that information. We also want to note that if you want to read in more detail, that the significant accounting policies related to the audited financial statements are disclosed in Note 1. Again, this slide also highlights the significant estimates that we previously discussed. And this final slide just confirms that, you know, we did not have any material unrecorded adjustments by management. Management was pretty good in terms of getting everything recorded. We had some discussion on GASB 96 as we worked through the process, but management was fully on top of it. We had no discussions with management. And just the last point in terms of our independence, I always want to just make it clear that Markham is independent as it relates to the authority. Any questions? Oh, go ahead, Chris. I'm sorry.
I was going to say thank you, Damien, and you covered it for me. If there are questions, feel free to let us know now. We could certainly answer them. Or if there are questions after this at any point in time, our contact information is right here on this slide. Feel free to reach out to Damien or myself. We'd be happy to walk you through any elements of the financials or answer any questions you have either now or during the course of the year. We do work for this committee and for the authority, so certainly we are available to help you at any point in time.
Do any members have questions this morning?
This is Mike. I just have one process question. Chris, you mentioned you review a sample of the denied claims. What's the extent of that review?
We we actually sorted them and looked for anything that was unique, any outliers in that population of claims that were denied. And then we went through and picked a representative sample of denied claims. And that sample was about 40 claims. And that was based on statistical analysis that would indicate a random sample of 40 would be sufficient to detect an error.
Okay, thank you.
And if that's an area of focus for the committee, we could certainly in future years expand that sample as well. They seem to be in line. There are good policies, procedures, and controls over the process. So we did not have any concerns with that. And some of them certainly were just information was missing. The information was provided. We made sure that the information was provided and the claim was subsequently paid. So we analyzed a number of those as well.
Right. Okay, thanks.
You're welcome.
Any other questions from members? Okay, not seeing any. Thank you very much for your presentation this
You're
morning,
welcome.
Marco. We appreciate it.
Thank you.
All right, so we're going to move on to our actuarial quarterly update from the spring group. So I turn it over to you all to present this morning.
Great. Hi, everyone. Good morning. We're going to put our presentation up on the screen. So let's just confirm that you can see it.
You can
Great.
see your screen.
Thank you. All right. So the purpose of our portion of the presentation is to talk about the quarterly results. So fiscal year July 2023 through June 2024 Q1 results for July through September 2023. So as we normally do, I talk about our results for the quarter and then also talk about our updated projection for the full fiscal year period. This first page provides the key results. On the middle column here provides the actual results, and the column on the right has the projection that we would have previously provided a few months ago, in conjunction with also finalizing the annual report for year-end purposes. Okay. The beginning fund balance is $557.2 million, and that is net of outstanding contributions and outstanding claims payments, and basically net of any reserves. Contributions earned were $106 million. It looks like it's about the same. In both periods, investment income was higher at $7 million. Income claims were also a little bit higher than the projection, so they were $90.6 million. Actual expenses, or other expenses, were lower at $5.7 million. And that's driven by, there were sufficient funds in the operating account, so it did not require a transfer of funds from the trust, or the trust fund. So there's typically we'd expect $5 million transfer. That's what's in our projections every quarter, but that was not required. So that was the big driver there. So the net activity overall was $16.7 million, which is positive, I guess, higher by about $4.5 million compared to the projection. So overall, we're at $574 million, $573.9 million, which compares to previously projected to be at the end of the quarter of $569.4. So relatively close, with some small differences there. Overall, our funding metrics continue to, across the board, we continue to meet the funding metrics relative to the targets. No concerns there. The commentary is that the fund position remains strong with the funding metrics within the target levels. Okay. The next couple pages, this page provides a graphical illustration of the same results. So on the left, you'll see the actual results. So we'll start off with a fund balance of $557.2 million revenue. So these are the contributions plus investment income, $113 million, expenses of $96 million. So we end up at $573.9 million. And on the right-hand side, we saw the same results that we would have based on our prior projection. So you can see that $1.5 million difference there for the end of the period. The same result that I spoke about The next page here, these represent the detail behind the results that I provided in the couple pages before this. I typically don't go through this in a lot of detail, except to point out that it's here. And to the extent that you'd like me to answer the questions, I'll go through this in further detail. I'm happy to as well. Moving on, the next page, this page provides the financial projection for the full fiscal year period, so the 12-month period, July 2023 through June 2024. What we have on the right-hand column on the right is the full year projection that we were presented previously. And then we have the updated numbers for this quarter based on everything we have for the quarter and kind of updating it based on what we know. So overall, contributions earned are approximately the same. We have reflected slightly higher investment income, but one of the big changes is that we've updated the incurred claims figure to be higher by roughly $20 million. So we are at 364 in this projection compared to previously 343 million. And that's driven by looking at the claims activity that we have been seeing over the last several months in particular. So this 364 million represents roughly $7 million per week of claims paid. We'll continue to monitor it, continue to update this, but just based on the recent activity, we thought it was prudent to increase this amount given what we're seeing in the data. And then the other expenses are down by 5 million, again, driven by what I mentioned earlier, that there was funds in the operating account. So we did not require a transfer of the $5 million this last quarter. So overall, net activity, 70.8 million projected compared to a previously projected number of 84.9 million. So ending fund balance, factoring that in, at the end of this fiscal year is projected to be 628 million. Yeah. And that concludes the kind of prepared material, and I'll open it up for any questions.
I have a couple questions. This is Holly, and I'm not sure if this is a question for the Spring Group or perhaps for Dave, but I know that the investment income is driven by the higher than usual return on the short-term investment funds for which, you know, contributions in the trust fund are deposited. And so I guess my question is, can you just kind of root that in a more historical context? Like, I think we're earning anywhere between 4 and 5% now, but that's an anomaly, right? So the investment income that's accruing to the fund, we don't anticipate to be a recurring source of income moving forward. We expect to see some dampening in that, right?
Well, in terms of what we're earning now, we're earning north of 5%, actually. I think it's almost close to 5.5%. I think the rate will, I don't want to make any predictions about the economy or anything like that. But the way things are going now, and with how the Fed is slowing down the number of increases to their own rates, I think that rate will continue on. Certainly for like the next 6 months or so. And that's been at the higher end of what we earned. A few years ago, when we first started the fund, it was earning a 0.1%, like next to nothing. And then all the rates shot up since then. And so that's why the investment income and the rate has gotten better and better than what we projected or even budgeted, because we weren't sure where it was going to go. So I think that's going to be a positive factor into the fund, the interest rate that we earn. Where it's going to go for the next year, you know, I'm not sure, but I think certainly for the next few months anyway, it'll hover around where it is now.
Okay, that's helpful.
Maybe I'll just add, sorry, just one more thing I just thought may be helpful more broadly. Just we have assumed 22.7, 22.7 in the projection here. So that is the lower on an average per quarter relative to what we saw in the first quarter. So we saw about $7 million in the first quarter. So we're averaging about 5 million for the remaining 3 quarters to get to the 22 million.
Okay, so some modest but not aggressive downward pressure on that assumption moving forward, which intuitively makes sense to me. That's helpful. My next question is on the claims. I know that we are seeing our claims paid increase, which is, I know, what we want, because we want contributors utilizing and accessing the benefits that they have available to them. Can you give me a sense on a percentage basis how we're how actuals are comparing to what was assumed in with regards to growth in claims? Does my question make sense?
Yes.
Okay.
So just in terms of actual versus expected, we have the numbers here. So 90.6 relative to 87.7. That's about 3% higher. But what we're also seeing is, on top of this, in the most recent several weeks back to back, very high amounts of claims relative to last year. Like if you go back a year ago, we were materially lower. And that's what caused us to go ahead and update our full year projection even beyond 3%. So we did want to at least reflect what we're seeing and continue to adjust as we see more data. But we are seeing 7 million and even in some weeks more than 7 million of claims that paid in a week, which is obviously a lot higher than what we were seeing previously.
Okay, that's helpful. I have one next question, but I don't know if any of my other members want to jump in now. I can table my final question to the end if someone else wants to take the floor for a few minutes. No? Okay. So my final question is, and perhaps this isn't a fair question, but in your experience, when you look at other plans, how is the claims growth? Does it track alongside what you're seeing in any other plans that you have experience with? Are we higher, lower, pretty on par for a program that's growing?
So if you asked me 3 months ago, or 4 months ago, I would have said, we're below what we would have seen in other programs. But just recently, we've seen quite a big increase in the claims. So that the recent activity, and again, jury's out if this will continue or, if this more of a shorter period thing. But that is, in my mind, higher than what we would have expected and what we would have seen even in other programs. It might be a bit of a catch up, but it's just difficult to say. So.
Thank you. Yeah, and so that's pretty consistent with what I had thought, particularly in a plan that's young. So, I think we're still experiencing and trying to feel out what a trend is for a program and what I would call its infancy still. So I appreciate your commentary on that. Does anybody have any additional follow-up questions?
I just have 1 or 2, Holly, thanks. So Harindra, I assume your projections take into account the minimum wage increase that's coming January 1?
Yes, it does. Yeah.
And did you say that we hit a week with, I'm not sure I heard this correctly, $8 million in claims?
I didn't specifically say that, although I know we definitely had like something close to 7.5 million. Dave, you might be able to.
Yeah, no, we haven't hit $8 million a week yet, Mike. We've been, I think our record week, which happened a few weeks ago, was about almost 7.5, 7.4, between 7.4 and 7.5.
Okay, well, you can see which way the trend is going. That's for sure. All right, thank you.
Does anybody else have any questions? I don't see any. So thank you very much for that presentation and for your responses. We appreciate it. We're going to move on now to the budget review of spending to date. So I turn the floor over to you, Dave.
Thank you, Holly, and good morning, everybody. We're going to go over the results for the month of October. Can you see my screen?
Yes, we can see your screen, Dave.
All right. Thank you for the confirmation, as always. All right. So for the month of October, for operations, we had spent $932,000 for the month. That compares to the budget, and we had a positive variance of $281,000. Overall, we had a positive variance of $333,000, and that is because of our fund recovery efforts. We had $56,000 of fund recovery penalties come in that are covering our fund recovery expenses. So we're seeing positive results from our efforts there so far. In terms of what the authorities spent on this month, it was the typical categories. Payroll and related expenses was $602,000. Contact center was $128,000. Outreach was $91,000, and IT consultant services was $50,000. Spending to date is almost at $4 million and is $1.1 million ahead of budget so far. Moving on to the bond, there we go. Okay, my screen will cooperate. We're at a month where we actually didn't have any bond spending this month. So it's the same exact numbers as, so year to date, our spending is $363,000, same as it was last month. We had budgeted some bond money, additional bond money coming in that isn't happening in October. We expect that actually to happen around January, but we're going to cover that in the next agenda item in a little while. So stay tuned. But for now, year to date, we are about $123,000 behind budget, but that's mostly because of timing on the website redesign and replatform. That went live later than we had anticipated. So we had spent the money during this fiscal year as opposed to the prior fiscal year. Bond money to date, like I said, we didn't spend anything this month, so same as last month. $2.4 million remaining for the authority to spend, and it spent about $13.5 million so far of the $16 million allocated. Moving on to our contribution activity for the month. The total contribution activity was over $69 million. That resulted in a $4.3 million positive variance. October was the month that the quarterly contributions come in. Well, most of them come in. We got in over $103 million. So that was $1 million ahead of budget. Our benefit payments for October were $29.4 million. That's continuing the upward trend that we're seeing and that we just discussed. That averages out to about $7.4 million a week. So the upward trend in benefits being used still continued through the month of October. Still less than what we budgeted, so we had a positive variance there too, which was the biggest contributor to the overall positive variance. Year to date, our activity has been almost $94 million. That results in a positive variance of almost $18.9 million. And again, the factors that contribute to that positive variance continue to be benefit claims paid. We are seeing it go up, but still less than budget. We didn't transfer the $5 million to the operating fund because we didn't need it for the first quarter. Investment income is higher than budgeted because we had budgeted conservatively at about a consolidated rate of 3.9%, and we're seeing it in the mid fives right now. And the contribution revenue coming in was somewhat higher than what we expected at $3.7 million. So all of those are contributing to the positive variance to budget so far. I just want to spend a second and show everybody quarterly contributions. October is the month where most of the contributions come in for the third quarter. Everyone gets a 1-month grace period after September. So the contributions for the quarter were $106.9 million, that third grade bar you see. That's about 4% higher than it was this time last year, and continues the trend of contributions going up every quarter during the year. Year to date, our contributions are 4.3% higher than last year. So this quarter's contributions are pretty much in line to what we're seeing overall throughout the year. The actual balance in the contribution fund at the end of October was $592 million, higher than it was last month, again, because we got the quarterly contributions coming in this month. So that's why it went up. Quick look at the balance sheet. Our total assets are $611 million. The largest asset continues to be the short-term investment fund at over $573 million. Starting this month, we are doing projections towards the end of the year now that we've got about 4 months of activity. So we wanted to see where we were going to be at the end of the year. And for the operating account, we project our expenses will be at almost $15.4 million as compared to a budget of $17.3 million. So that's almost $1.9 million ahead of budget. Overall, I know you see a negative variance of $2.4 million, and you're wondering, why is that? And again, just as a reminder, we didn't transfer the $5 million into the operating account the first quarter because we had enough funds available. And you'll see the positive variance on the contribution page, which is the next one. But just in terms of operating expenses, we are ahead. And the two biggest drivers of that are payroll and related expenses. The positions we had budgeted are being filled later than we anticipated. And also there was a positive variance in our grievance adjudication expenses. That volume is coming in lower than what we budgeted, and we expect that lower volume to continue through the rest of the year. For the contribution account, we are forecasting that the activity will be almost $68.5 million by the end of the year. That is over $55 million positive variance. We did work with Spring to update our contribution numbers and benefit claim expenses, putting them on a cash basis because Spring has them on an accrual basis, but just to make sure it's an apples to apples comparison. But compared to budget, we expect to be ahead of the game. So far, the benefit claim as claim expense is at $364 million. That is lower than what we budgeted at $400 million. But when we budgeted over 6 months ago, we were budgeting very conservatively at that time because, as people have pointed out here, the program is still young, is still new, and is still subject to fluctuations. And has also been pointed out, the number has been going up recently. So we just wanted to make sure we accounted for that. But that's where we are for the month of October and where we think we'll be by the end of the year. Does anyone have any questions?
Doesn't look like it. All right, so now you're gonna run us through a bond update.
Yes. Okay. Moving on.
We can see your screen, Dave.
Okay, let's get this in slideshow format so it's a little bigger. Okay, so the authority is planning to make another bond funding request at the December Bond Commission meeting, which is scheduled about a month from now. Just some background in terms of how the bond funding works. So the authority has been authorized $50 million in bond funds. It was authorized $25 million in the first year of existence and another $25 million in the second year of existence. And the bond funds are intended to fund the authority's IT systems, like the employee contribution system, the web portal, benefits administration, things like that. The authority is also required by statute to reimburse all the bond funds allocated to it. And so, as you're probably aware, as of last June, we made our first payment. We had finalized the payment plan with both the Office of Policy and Management, OPM, and the Office of the Treasurer, OTT. In terms of what's been allocated so far, you probably get a sense of deja vu. If you've been listening to what I've been talking about regarding the bonds, we've had $16 million allocated so far. Back in 2020, we had almost $8.8 million allocated, and that was for the employee contribution platform, including the website. In 2021 and 2021, we requested and were allocated another $5.25 million. And that was for further work on the employee contribution system, also for the benefit claim system, some data integration requests, and things like that. In 2022, we made yet another request of $3.8 million, and that was for the fund recovery system, which is in place now. We also had some further data integration work, and as well as some website redesign and replatforming, which went live a couple of months ago. So for now, in December, we are requesting another $3.5 million, and that can be broken out into five major categories: fund recovery, portal functionality, data analytics and integration, identity verification, and private plans. Just going to do a quick summary for each of those items. So for fund recovery, we're asking for additional funds because we'd like to implement a solution to recover underpayments. The initial focus for fund recovery so far has been on no payments for people who haven't paid at all. So we'd like to go to the next logical stage and implement a solution for underpayments. We also want to audit those accounts to validate previous payments so we can help determine if employers have underpaid or not. We'd also like an option to integrate the system with outside fund recovery vendors that we use. So we're not a collection agency, so we're going to be using outside, or already are using, but we'll be using more in-depth fund recovery vendor in the future. But we want to integrate the system together so we're just not manually sending files all the time, which can get messy. We want to make sure that everybody's on the same page at the same time and everybody knows how much an employer owes in real time. We're also looking to expand payment options with instant payment platforms. You probably heard some of them, like Venmo, Zelle. We'd like to make that available to employers as well. We also want to make some necessary improvements to the base software product we have now. Everything's working the way it should, but there's always room for improvement. So we want to do that. And we also want to integrate the benefit overpayment feeds to and from the claims administrator. Again, so everyone's on the same page. We don't have to send files manually. And again, everybody knows how much someone owes in real time. Next major category is portal functionality. We'd like to expand certain features that are available to the public, things like a video library, having board meeting minutes available, documents for public comment, other important notifications, things like that. We'd also like to increase the opportunities to better align with other Connecticut state programs and their websites. We also want to participate in interagency projects, including the state's digital government plan, which has been a big initiative the past few years. So we want to be a part of that again. So we're on the same page with the state. Also want to make some improvements to our current My Account, which is what people use so they can look in their account and check out their current status. Also make some improvements to the registration process so we can better capture employer contact information and also be able to do vulnerability scans. Next major area is data analytics and integration. And so we're looking to implement a software solution that analyzes program performance and statistics. Why do we want to do that? Well, for our own process improvement, to make things better. That's number one. And number two, to have those statistics available for research. So we can compare ourselves to other state programs easily enough and have that data easily available. We also want to expand the functionality of our integration feeds with other state agencies and our third-party administrator of benefit claims. And also we want to create an agency-wide auditing solution for everything we do, including the Salesforce program, claims, contributions, everything. We want to have one solution for the authority. Identity verification is another topic. That's important as we want to decrease the potential for any fraudulent use of identities by any people out there to get claims that they really shouldn't get. So that's important to us. We're participating in a state initiative for stronger identity verification, and that includes interfacing with databases for legal and public records, interfacing with other state agencies, and also an IP address validation, all to help us better identify that the people, to help us better identify two things, actually. Number one, better identify the claimants really are who they're claiming to be. Sorry for the pun. And also to also identify employers so that make sure they are who they say they are when they're making contributions. Last but certainly not least, private plans. We'd like to make some needed enhancements both for auditing functionality and for reporting functionality. We also want an easy way to collect information for private plans, things like employee counts, employee contributions, approved claims, denied claims, things like that, just so we could readily have that information available. And also, we've had some large employers make a request that they'd like to file their annual reports at the parent company level instead of at their subsidiary companies level. So we'd like to implement a solution for that as well. So right now, the request has been submitted to the Office of Policy and Management, and they're currently reviewing it. And then assuming it's okay with them, then we will go to the next stage, which is actually go to the bond commission and run it through them. And assuming they've approved it like they will in the past, then we'll get the additional amount recorded in our allocations and use it appropriately as intended. So that's our update on our request for bond funds. Does anybody have any questions?
I don't see any. Thank you, Dave, for bringing us through that. Do we still have a quorum, Stephanie? I believe we do.
Yes, we do.
Okay, thank you. So I'll just go back to item number 2 then, which was a review of our September 22nd, 2023 meeting minutes. And I'd like to ask for a call to approve.
So moved.
I'll second.
Thank you. All in favor?
Aye.
Aye.
Aye. Any opposed? Any abstentions? All right, the motion carries. Thank you, members, for staying on. Any old business this morning? No. Any new business? All right, then may I have a motion to adjourn?
So moved.
Seconded.
Second? All in favor?
Aye.
Aye.
Any opposed? Any abstentions? All right, the motion carries. The meeting is adjourned. It is 9:53 a.m. Thank you, everybody, for your time this morning, and have a lovely week next week.
Okay.
You too. Thank
Thank
you.
you.
Bye.
Bye, everybody.
Thank you, everybody. Have a happy Thanksgiving.
Happy Thanksgiving.